Alrighty. So in today's video, we're going to be talking about the three best stocks for trading credit spreads. And by credit spreads, I'm really just focusing on is the bull put spread for this video, right? So generally when it comes to trading credit spreads on individual stocks, I tend to prefer to trade more towards the bullish side because I tend to choose stocks that I think that it's going to go up in the long term. So for this video, we're going to be focusing on the bull put spread for the credit spreads. All right, so let's get into the very first stock. And the very first stock that is good for trading the bull put spread, and that would be Google. So Google, the ticker symbol is GOOGL, and it is a tech stock. All right, so why do I think that, Google is a good stock to trade the bull put spread? Well, for a number of reasons, right? So the very first reason is that it has pretty good liquidity and has relatively tight bid and ask spread, right? So as you can see down here, the bid and ask spread is roughly about, anywhere from 2 cents all the way to about 10 cents, right? And this is, I took this picture when the market is, closed, but when the market is open, chances are that the bid and ask spread will be a little bit tighter. So I think this is pretty decent, right? Especially, Google is about $100 over. So this should be a very decently tight bid and ask spread, and there's a lot of liquidity for Google as well, right? It's a very widely traded stock, so you should have no problem getting fills pretty quickly. Now next, it also has pretty decently good volatility, which means that you can get decent premium as well. So as you can see down here, it's about 30+%, right? It's not that too low. At the same time, it's not absurdly high like some of the stocks like GameStops or AMC where they're a few 100%, right? Basically, when you have very, very high volatility, although you can get, very good premiums, what it also means is that you're going to take, quite a considerable amount of risk because it just means that the market, is expecting that the underlying is going to move a lot, right? So in this case, Google is about 30% which you can get pretty, decent premiums to get into your credit spreads, right? Your bull put spread. Now next, it is also a fundamentally good stock, right? So again, I like to choose stocks that are fundamentally strong. So this way I know that at least in the long term, there's a higher chance of it going up, right? And since I'm going to be playing to the upside with the bull put spread, I definitely want to choose a stock that in the long term is going to go up, right? So with a fundamentally good stock, right, how you want to define fundamentally good stock, generally it can be pretty subjective. Let's just put it that way, right? So for me, the way that I see that is fundamentally good stock, well, one of the criteria that I'm looking out for is that, it must have like increasing revenue as well as, the income. So as you can see for this, Google has been doing pretty well, even during the pandemic, right? In 2020, it didn't really suffer that much. In fact, I think during the pandemic, it did pretty well, right? Because people are starting to go online and a lot of the businesses have shifted towards more of an online presence. So, they have many businesses that's focused on that towards the online presence. So you can see that 2020, 2021, 2022 revenue has increased. Net incomes has generally increased over time as well. So this is one of the bases that I'm looking for when it comes to fundamentally good stock. Now, of course, there are many other aspects of a fundamentally good stock, but that's not the real main point that I want to dig into for this video. Now, next, it is also still currently slightly undervalued. Well, according to Simply Wall Street. Now, there are many different sites that give their valuation. This is just one of the sites. So you do want to do your own due diligence, but just by following this, you can see that the fair value is slightly above where the current price is now as of this recording. So now this is not a very important aspect as to why we want to put on the bull put spread, but it certainly does help, right? Knowing that if the valuation is higher than where the current price is, then again, right, we're just putting another point in our favor, right? Another way to put the odds in our favor. So again, everything, it comes down to probability. So as much as possible, I want to put the odds in my favor when I'm choosing the stocks to place, like bullish trades on, right? Like for example, the bull put spread. So how do you enter into a bull put spread on Google? So there are a few steps. I'm going to just give you 4 very simple steps to just get started, and it'll be very good for you as well if you're just, starting out trading credit spreads as well. It's going to be pretty simple, right? So the very first step is to add the stochastic oscillator, right? So the stochastic oscillator is basically this one that you see down here, right? Some people like to put on the RSI. To me, I think they're both pretty similar, right? Basically what it does is that it tracks the market condition, whether is it overbought or is it oversold, right? So anything above the line down here, this red line over here, right, that is what you would be considered as overbought, right, OB. And anything that goes below this line down here, right, I will consider that as oversold. So because we're going to place a bullish trade, well, we want to put the odds in our favor as well. So we would be better putting on the trade when the indicator is suggesting that the market is oversold, right? So when it's oversold, then there at least is a higher chance that the market is going up. Now, that is not to say that the moment it's oversold, it's guaranteed that the market goes up. No, there's no such thing as a guarantee that it will go up based on indicators, right? Again, it's based on probability, and there's always a chance that the market can become even more oversold after getting into the oversold region, right? But what it just does is that when we enter into a trade at oversold, it at least gives us a better chance, a better probability that the market is going to go back up from there, rather than when we place a trade when it's overbought, right? Imagine if you place a trade, a bullish trade when it's overbought, right? So as you can see, the overbought will coincide with somewhere here. So if you put on the bull put spread down there, it's not going to be that strategic compared to if we put it on somewhere down here when it's oversold, right? So that's the whole idea of the stochastic oscillator. Now, if you're wondering what is the settings that I put for the stochastic oscillator, well, I've already created a video on that. Then you can just go to my channel and search for the stochastic oscillator. I'll share with you my settings and how I put it on, right? So you can just go to that video and watch there. Now, the second step, step number 2, is to identify the nearest support level, right? So as you can see down here, I've already drawn a line down here because to me, this would be the more significant support level compared to this one down here, right? So this one down here, some people can say this another support level. So basically support levels are places where the prices have bounced off, right? So basically this can be a support level, this can be a support level, right? But basically I want to look at the one that has not yet been tested, right? So in this case, the market, right, as you can see down here, this could be a support area, but the market has already broke through it. Now from here, the market has come down here, but it has not tested this level just yet. So I'll consider this as the support level that I'm looking out for, right? Some people might look at 130, right, closer to where 130 down here, but I think this is pretty close to the 128 one, the one slightly lower. So I'll just go for the one that is lower. All right, so that is step number 2. Now, step number 3 is to wait for the price to come down and for the stochastic oscillator to be oversold, right? So the first thing that I'm looking out for really is for the stochastics to get to an oversold region. So from there, then I will start to look for places to place on the bull put spread. So generally, when the market comes down and then the indicator, the stochastic oscillator says it's oversold, let's say, for example, it goes to somewhere around 130, then this is where I will start to identify, where I can start to place my bull put spread, right? Because it has yet to breach our support level at 128. So I would, use this 128 as a support level, as a way for, in case if the market does come down, right, touches this point, there is a chance that it could bounce back up. So this is almost like a defense area, right? Almost like a wall, because support levels are places where the prices can bounce off again. Now, of course, that is not always going to happen, but it's much better than if you were to, just choose a level that's arbitrary, in the case whereby, let's say, for example, you choose 134 and thinking that's going to be, place where the price might bounce off, right? Because we do not see any evidence of the price actually bouncing off here, right? We don't really want to use this level. So in this case, I'm using 128 as the level to identify where I can place my bull put spread. So this brings us to our next step, and that is to place your bull put spread below the support level, right? So as you can see down here, several things have already lined up, right? So generally when we are placing the bull put spread, I like to be a little bit more contrarian. That means when the market is coming down, then I'm going to look to place our bull put spread, because it also helps our strategy. Because in general sense, when the market actually comes down, what happens to the volatility, right? More often than not, it actually goes up. Now, that is not all the time, of course, because there are certain times, especially in the recent, weeks and some months as well, the market goes down, the volatility also goes down. And sometimes the market goes up, volatility goes up, right? But most of the time, when the market goes down, the volatility should pick up as well. And this would give us, a better structure for our bull put spread. Because for this credit spreads, for us to get more premium, we want the volatility generally to be a bit higher. So that is why we want to enter into such bull put spreads when the market comes down. So let's say, for example, the market has come down somewhere around 130, and just nice the stochastic is saying there's oversold. Well, this time I'll pull up my option chain, right? I'll pull my option chain and then I will start constructing the bull put spread, and I want my short strike, right, to be below the support area. So again, this is like a defense whereby, if the market comes down here, it could bounce back up after hitting this support area. Now, as for what delta to choose and how wide you should construct the put spread, I've actually already created several videos on that. So one of the videos that you can go look out for would be the 7-step credit spread trading plan, or the $10,000 credit spread trading plan that I already have on my channel that I've created. Over there, I specify, exactly what is the delta that you should enter into, and also what is the width of this put spread that you should be entering based on, your account size. So I'll put the link at the top right hand corner of this video. You can go ahead and click that if you want to watch that. Now, next, what happens if you can't get a decent premium at this point of time, right? Let's say, for example, the market has come down somewhere down here, and maybe the premium is not that good. Well, if this is the case, then what you want to do is just wait for the price to go slightly lower. So as it goes slightly lower, then you'll be able to get more credit for the same strikes that you choose, right? Let's say, for example, you have identified 126 as the strike that you want to choose for. So obviously, when the market comes down and the 126 strike becomes closer to the market, that's where you can get slightly more premium. So that's what you want to do. Now, what if the price has already gone past the support level before the stochastic is oversold? Then in this case, you want to use the next support level, right? Let's say, for example, if the market reaches around 125, then your stochastic becomes oversold. Then in this case, you notice that it has already breached this support level at 128. Well, in this case, just go for the next one, right? So the next one, as you can see, I've identified down here, which is roughly around 120. Then from here, you can take a look at the option chain again and then construct a bull put spread where your short strike, the short put, is below this 120 support level, right? So maybe you can go for something like 115 or 118, whatever you can get at the point of time when you take a look at option chain. And same thing again, let's say, for example, you're not able to get, a good enough credit when it comes to constructing your bull put spread, right? So what you can do is wait for the market to go a little bit lower, then you take a look at those strikes again and see whether you can get the desired premium that you want. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Now, the next stock that I think is good for trading, credit spreads like the bull put spread, and that would be Meta, right? Meta basically is Facebook, right? So Meta, the ticker symbol is META, is also a tech stock. So again, why is this a good stock to trade the bull put spread? So similarly, it has pretty good liquidity and relatively tight bid and ask spread, right? So Meta is much more expensive than Google. So obviously, you will tend to see the bid ask spread slightly wider than for Google. But in terms of the percentage, in terms of the width, or rather the spread between the bid and ask spread, actually pretty decent, right? As you can see, it's about 20 cents wide at the money around here, right? At the 3, 4, 5 strike, about 20 cents. 350 is about 20 cents, and this is about $300 odd stock. So I think it's perfectly fine for you to get into it. And again, Meta is a very high liquidity stock, right? A lot of people are trading these stocks as well. Now next, Meta has pretty good volatility, which means you can get good premium. So as you can see down here, the volatility is much higher than Google. Google is averaging about 30%. Now for Meta, you get about 40 odd percent, right? So for 40+%, you can definitely get a much better premium, which means to say, you could get a better structure compared to if you were to trade it when there's lower volatility. Now next, in my opinion, Meta is also a fundamentally good stock. So as you can see, for the most part, right, the revenue is generally increasing. Your net income is also increasing, although in 2022, right, it was affected a little bit. But I still think that Meta overall is still a fundamentally good stock. And I do think that over the long term, it's still going to go up. So again, this will be a very good candidate for us to trade the bullish side, right? So in this case, the bull put spread. And it is also still undervalued, again, according to Simply Wall Street. Now, again, you want to to do your own due diligence to find, the site where you're most comfortable with the valuation. So for me, I just take simply Wall Street, right? Again, to me, this is not very, very important, but at least it's nice to know that, the fair value is above where the current price is, which means to say there should be some room for the market to still keep going up. So that is why, again, we want to play to the long side. All right, so how do you enter into a bull put spread on Meta? So again, same thing, right? Step number one, we add the stochastic oscillator. Step number two, identify the nearest support level. So as you can see, I've identified somewhere around 315, which is where, there was this last bounce. Now, step number three, same thing, wait for the price to come down and for the stochastic oscillator to be oversold, right? Once I see it's oversold, then the next thing I'll do, I will go over to the option chain and then start to identify the strikes that I want to choose. So again, I want to place my bull put spread below the support level. So this gives me an increased chance or a higher probability that the market is going to go up rather than it continue going down. So as you can see, we've got a few things going, in our way, right? Firstly, we've identified the support level. Next, we have the stochastic oscillator being oversold, and at the same time, we have a contrarian approach. That means the market has already gone down, right? So if the market has already gone down, at least to say that there's probably a better chance of it, going up than it immediately going one straight line down, although that can be possible if there's some big news that's going to come on. But for the most part, we have most of the probability lined up in our favor, and we just want to go with the odds, right? So we know that at least in the long term, we have winners and losers, but overall, the winners are going to outpace the losers, and we're going to become net profitable. Now, what if you can't get a decent premium? Then same thing again, just wait for the price to go lower and then you enter into the bull put spread, right? So you don't have to force a bull put spread at any time the moment you see this is oversold, right? You also have to wait until the conditions are right for you to get, at least a decent premium. Next, what if the price has already gone past the support level before the stochastics is oversold? Then again, use the next support level. So for example, maybe the price has gone down to 300 before you see the oversold signal. Then in this case, you can use the next level, right? 275. And chances are, let's say for example, if the price really is at $300, then you might have to wait for the price to go further down before you're able to get some decent premium to put on this bull put spread that is below this next support level at 275. Now let's go to the last and final one, the third one, and that is the S&P 500 Index ETF. The ticker symbol is SPY. Now, SPY is not exactly a stock per se, not an individual stock, but it's a basket of stocks, right? So the SPY is a broad-based index ETF. So why do I think that the SPY is good to trade the bull put spread? Well, first of all, the SPY, the index ETF, has a positive drift, right? So this positive drift is a very, very important thing you want to understand, because over the long term, the market just wants to go higher. As the companies get more profitable, the stocks gets more and more expensive. So as you can see, if you go all the way back to a decade ago, or even more than that, you'll notice that the index ETF has just gone higher and higher each time, right? That is not to say that the market won't go, down in the short intermediary term. But over the long term, the next 10, 20 years, the market is going to go up again. So generally, there is a bullish bias in this index ETF, right? So that is why, again, since it has a bullish bias, I want to go more towards the bullish side. So again, I'm putting the odds in my favor. And also, the index ETFs is much less volatile than individual stocks, which means it's less risky. So as you can see in this graph down here, they compare the ETFs versus stocks. So this is a study done by Tasty Trade team, the research team. They have studied this and they have noticed that, based on their results, the studies, ETFs tend to stay in a narrower range compared to stocks, right? So stocks can have a very wide swing. So when we are trading this bull put spread, the credit spreads, basically any short option strategies, we do not want the underlying to move that much against us. That is why when you trade the index ETFs, it's generally going to be much safer than trading individual stocks. Now, more importantly, why I think that SPY is a really, really good underlying for us to trade the bull put spread is because the extensive studies have already shown that the bull put spread is profitable over the long term. So as you can see, this is a study, it was again done by the Tasty Trade team. What they did in this study is that they just put on the bull put spread over and over again, right? You can see that they compared two different management, right? One of them is to hold it to expiration. The other one is to get out at 21 DTE. That means once there's 21 days left to expiration, they just close the trade and put on a new one. So as you can see, both of them are actually profitable, and this study have spanned across for the past decade or so. And it makes sense, right? Because if you were to put on the bull put spread, on the index ETF where it just keeps going higher, at the end you're going to become net profitable, right? So that is why the bull put spread is very good strategy for us to use on SPY. All right, so how do you enter into the bull put spread on SPY? So same thing, we bring up our 4 steps. So the very first step, again, we want to add the stochastic oscillator. Now, step number 2 is to identify the nearest support level. Now, for the SPY, what you'll notice is that there's no real clear, clean-cut support level compared to when we were taking a look at Meta as well as Google, because there's a place in time where the market did bounce down and then go back up again, and we could identify this as the support level. But for SPY, you notice that there really isn't this very clear or clean-cut price movement down, the retracement, where we can identify a support level. So what I've chosen as the support level is basically the previous resistance level. So as you can see down here, the prices has bounced off here. So normally when the prices have broken up the resistance, that could be a good place where it becomes a support level again, right? That means the market could come back down here, and then because it has been a resistance level before, there's a chance that the market could bounce back up again. At the same time, you can see there's some consolidation down here where you keep testing this level down here around 453, and then it just went up from there, right? So we could use this as a support level. Now, if you're a little bit more conservative, then you might want to use the next one, right? So the next one will be somewhere down here around 437, 438, right? As you can see down here, the price over here has kind of consolidated for quite a bit before, it went down and then broke up again. So what might happen is that the price could come down here and then find this as a support and then go back up again. So again, it really depends on how you want to see it. If you're a little bit more aggressive, you want to get into a trade, soon enough, then you might want to go for this one down here as the support level. If you're a little bit more conservative, you want to trade to work out a little bit, at least have a higher chance of the trade working out, then you might want to consider the lower support level. All right, so that is for step number 2. Now, step number 3, wait for the price to come down and for the stochastic oscillator to be oversold. So again, same thing. If you're choosing the one, that's slightly higher, then you might want to wait for the price to come down here and take a look, is it already oversold? If it is oversold, then you can start to look at your option chain and then, get into your bull put spread. Again, you want your bull put spread to be below the support line. But let's say, for example, at this point, when it goes to 460, you'll notice that it's still not oversold, right? Let's say, for example, this is not oversold yet. And even though if it comes down here to this support level, it's still not oversold, then you want to use the next one, right? So the next one, same thing, you wait for the price to come down a little bit lower. So let's say at this point, around 444, you see that, hey, it's already oversold. Then you start to place your bull put spread. So this is where you go to your option chain, same thing as how we normally do. Go and find the strike prices that you want that is below the support levels that you have already identified. Then see whether you can get enough premium for that. If you can't get enough premium, wait for the prices to go a little bit lower. So again, this is for the slightly more aggressive support level, and this is for the more conservative support level. Now, if you can't get a decent premium, like I mentioned, just wait for the price to go a little bit lower before entering the bull put spread. And if the price has already gone past the support level before the stochastic is oversold, then use the next level. So in this case, let's say if the market has gone all the way to 432 before you see oversold, which is highly unlikely because chances are, since the market has already dropped quite a bit, it should be oversold by this point. But let's say, for example, it's not oversold, then the next support level would be somewhere around here. So as you can see, guys, this is very 4 simple steps that you can use, right? Step number 1, use the stochastic oscillator or RSI if you feel more comfortable with that. Identify the nearest support level. Wait for the price to come down and for the stochastic oscillator to be oversold. Then you take a look at your option chain and find the bull put spread strike price that's below the support levels. Alright guys, so these are the 3 best stocks that are great for trading credit spreads, more specifically the bull put spread. By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do
do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.